Hey everyone, so in this tutorial I'm just going to go over certain order types and why you would use those order types. So if you find this information useful, stick around, subscribe for more informative content, and don't forget to smash the like button and enjoy the video. Okay, in this video I'm taking a look at order trading types. I mentioned in the last video there was a paper trading account on TradingView that you can use to place orders, but there are a certain handful of orders that you use on a daily basis. So in this video we'll take a look at them and why you may use them and why you may not. You can right click on the chart and you can go to create order, and there's a market order comes up now. The market is well, this is a replay, so the gap shouldn't be $5.30 on Apple because it is because, well, you know, it's a replay and the markets are closed. But we don't actually have any trading going on, but the market would simply be buy or sell, or you want to sell, buy, you wanted to buy Apple. The market order will put me in the market at the best available price for however many shares I'm willing to pay for, okay? You can set your stop loss, your take profit right away, and just put in, say I wanted to buy it right here at this price or the best price available, and it will fill me at the best price. It might be $219.31, it might be $219.30, $219.29, $219.33, whatever it is. As I'm sure you're aware, it's not usually this much of a spread, but a market order is the easiest way to get in at the best available price. Okay, you do get some slippage, so it's not the preferable way to enter. So there are limit orders as well, and a buy limit order, which will be buying at a price limit, goes underneath the current price. So let's say that I'm willing to buy this stock, but I'm only willing to buy it at $216. Okay. Again, this is a very widespread. It's not typical. So what happens is that it puts it out there, and if someone's willing to sell my 100 shares to me at 260, my order will get filled, and then we're off to the races. Now, you can also use this as a way to get out of a profitable short trade, and you do it underneath the ask. So say you were short from 220 or 250 or whatever. If someone's willing to pay you 216, you're willing to get rid of the trade. Now, the problem with limit orders is that if your particular price doesn't get hit, if there's nobody willing to, in this case, to sell to you, it'll just skip right past you. They say if you say I'm only willing to pay this amount, now a sell limit order is exactly the same thing, but an opposite. So it's above the current bid. So in this case, I want to sell at 216. Right now, they're only bidding at 214. So they need to drive the price up to me, and I will sell them 100 shares. It's also a way to perhaps take profit on the way up. But if it blows past 216, it might be 216 and 25 cents before you realize that, and you know this is the case. But you make more profits, and that's not a bad thing, but just to let you know that your order may or may not get filled. But it is a way to get out at that specific price. So that's a sell limit order. Now, there's also the buy stop order. So buy stop order just means that it's a bid that's placed above the current price. So I'll just do 220, and it's only filled at or above that price. Now, why would you want to buy, say, at 220? Just say you get some slippage, it's 5 cents. Well, the reason is that perhaps you're going short, for example, and you're looking to protect profits or just protect against major losses. So once it hits this price, it'll get you out of the market at the best available price. Now, it may slip a point or two, you don't know. but it's a way of protecting your account. If you would, it's basically a stop loss on a short position. It is a good way to think of it. Okay, and it's a market order. So again, it doesn't guarantee you'll get filled at that price, but if you were to do a buy limit order instead, if it skips your price and you're still in the market, that could be a lot of trouble. Okay, if it's a fast moving market, it could just blow right past you. You could be up at 225 and still short this position. So that's why you want to use a stop as a way to protect your account. The last thing you want it to do is to have it pile up on you. Now, there's also the sell stop order as well. As you can imagine, it's the same thing if you're long. If you're in the market and you want to protect, say, 200, you want to get out, it's a market order to protect your long position. It doesn't mean you'll get out at 200. You might be 199.99 or 199.98. But typically with liquid stock like Apple, in this case, you'll get a bit of slippage. Okay, it might be off by a couple of pence or a couple of pennies or whatever. But it's a simple way to protect yourself from getting into major trouble. Now, these are mandatory. You absolutely must use these type of stop loss orders, because if you don't, you can get into a lot of hurt. Now, a stop loss here, like if you just go in with just say the market, the stop loss acts as a stop loss order, and so does the take profit. If you wonder what those are, okay, it's the same thing. Those are stop orders, stop limit orders. The easiest way to remember this is the market order. It doesn't matter, just get me into the market. Okay, limits I'm willing to pay or sell it at this exact price or better. And a stop loss or stop order stop losses. So essentially, this, if it reaches this price, this level, I want out as quickly as possible. Okay,